Hi, everybody. It's Chris Bull and Mark Armbruster with Armbruster Capital. We're here today to talk about investment risk. We just finished up the most volatile quarter ever for the stock market. Dow Jones Industrial Average is currently down 24% from its high, but is also 20% above its recent low, which I think illustrates just how crazy stocks have been lately. 1,000-point moves for the Dow have been quite common. Everyone knows that risk and returns are interrelated. Investments with the highest risk profiles generally are also the best performers over time. In fact, without risk, there would be no return. The T-bill, the Treasury bill, for example, is thought to be riskless, and currently the yield offered for a 30-day T-bill is below zero. So no risk, no return.
Yeah, along those lines, the table on slide 2 should be familiar to most of our clients because we use it with every new client to discuss asset allocation when they first sign on with us. It shows the performance and risk of various mixes of stocks and bonds going back to 1926. Unsurprisingly, you can see that as returns rise, returns do rise as you move away from bonds and towards stocks, and risk also rises since stocks tend to bounce around more than bonds do. Risk here is measured by standard deviation of return, and that doesn't mean much to regular people, but if you think back to high school math, standard deviation can measure the dispersion of outcomes or the volatility of a return series.
So on slide 3, we illustrate what a normal distribution looks like. In a normal distribution, the average return plus or minus one standard deviation account for about 68% of expected outcomes. The average plus or minus two standard deviations account for 95% of outcomes. So, these statistics can help us estimate the downside risk of stock returns, which is what most regular people think of as true investment risk.
So if you go back to our table, these statistics indicate that if you have a portfolio that's all stocks, it could fall 30% or so in a two standard deviation event. Actually, historical returns shown us that that's not too far off, but it's not perfect either. In 2008, stocks fell 37%, so more than what would have been predicted, but in the ballpark. Interestingly, though, if you look at the worst bear markets historically, including the most recent one in 2007 to 2009, the technology bust, the dot-com bust back in 2000 to 2002, and what happened in the early 1970s in the wake of the Nifty 50 era, you saw stocks fall by roughly 50%. So how do you reconcile that, the actual returns with the theoretical statistics? Well, really a couple ways. One is that bear markets don't always follow calendar years the way that our analysis does. Sometimes they stretch out for multi-year periods. And so instead of 30% in one year, it could be 50% over 2 or 3 years. Also, two standard deviation events only account for 95% of outcomes. There is still a 5% chance of more dire returns. Finally, stock market returns are not normally distributed. They approach normalcy, but there's still room for discrepancies between actual and expected returns based on a more normal distribution.
So, expanding on Mark's thoughts, we've illustrated here on slide 6 the worst historical bear markets. And as you can see, some of the drawdown numbers and peak to trough numbers over those periods of time are pretty significant. However, the forward returns going after it also make a case that it's not all bad. And so, what all this means is that while losses in the stock market can't always be anticipated or explained as fully as we'd like, they are, unfortunately, a part of the investment experience. Many investors, including a lot of the financial media, believe that the point of portfolio management should be to sidestep bear markets. However, the available data is not supportive of this. Most academics would tell you that bear markets cannot be avoided and just need to be endured. These periods eventually pass, and stocks recover to go on to make new highs. Bear markets are therefore a blip, as uncomfortable as they are, and we should not spend a lot of time or money trying to avoid them. We don't think most individual investors see it this way, but the alternatives are not attractive. Trying to time the market can be expensive and is notoriously difficult to do. Hedging portfolios can be expensive as well, which reduces realized returns over time. So, taking the long view is the best approach, even if best in this case really means least bad.
Okay, so I think that's a good point, and it raises the question: if portfolio management isn't about avoiding cyclical bear markets, well, what is it for? And the answer really is to control risk, but not short-term risk. It's about long-term risk, like regime change, what academics call regime change. And that really is when long-held beliefs or long-standing patterns in the capital markets change course all of a sudden. This happened in Japan back in the 1980s. Japan was sort of a normal country and a normal stock market for many, many years. And then in 1980, it sort of caught fire and the stock market went crazy. It went straight up and had these unbelievable returns. And that seemed great for a short period, but then it went down a lot. It lost quite a bit, over 50% very, very quickly. And since then, for about 30 years, Japanese stocks have bounced around. There's been a tremendous amount of volatility, and if you were an investor just in Japanese stocks and you bought in 1989, you'd even today be just barely above where you were when you first bought into the market. And so, regime change here was that when a fairly normal market went haywire, and if you didn't account for that in your portfolio management strategy, and you were just invested in Japanese stocks, or you had a lot of home country bias in your portfolio, you would have paid the price for that. Another example, maybe closer to home, is on slide 8, and this has to do with yield. So if you're an income-oriented investor, this might be something that's interesting to you. That for almost 90 years, stocks offered yields that were higher than bond yields. That seems crazy to us today. Typically today, we think about bonds offering is being income-based investments and stocks being more for long-term growth generation. But that didn't used to be the case. And it actually made sense the way that it was. Stocks were riskier than bonds, so of course they paid a higher yield. And that was back in the days where yield was expected to be a bigger component of total return than it is today. And some of that had to do with the tax code, and some of it just had to do with the fact that people expected periodic income payments from their investments. But that changed somewhere in the late 1950s. I'm not sure why, but somewhere along the way, bonds started offering a higher yield than stocks did. And that went on for about 50 years. And so for the past 10 or 15 years, stocks and bonds have had roughly the same levels of yield. So for investors seeking current income from their portfolios, these shifts could be meaningful. We're not big income investors here, but I think this pattern where you had something that persisted for so many years and then changed course and then changed course again 50 years later is really important for us to think about how we manage risk and how we think about the dynamics within our portfolios and ultimately how we build those. So building portfolios that account for the potential for long-term regime changes are far more important than hedging against short-term bear markets.
Along those lines, what then do we make of bear markets? For real investors, they're all about opportunity. These are the times when higher than average returns can be earned. The investment greats like Warren Buffett seize the opportunities to buy stocks when they are cheap, and we should be doing the same. Warren Buffett always has large amounts of cash at his disposal that he can use to invest opportunistically. But even without large amounts of cash, we can buy more stocks by rebalancing portfolios when stocks are down. Selling bonds and buying stocks when they are at their lowest can make a huge difference in how long it takes to rebound from the market's depths and can result in significantly higher long-run returns. We want to take advantage of that as much as we can.
So our message today really is to embrace risk. Don't be surprised by it. It's a part of the investment process. You've lived through these periods before. You're going to live through them again. At least we hope you do. And that's okay because downturns in the market are a buying opportunity. It can help us get better long-term returns, and it can also help us avoid paying capital gains taxes if we realize losses when stocks are weak. These are both good things and should be looked at as strategic opportunity, not as a reason to get scared.
As always, if you have any questions about your particular portfolio or situation, please give us a call.